Now we're going to talk about Chapter 2, Consolidation of Financial Information. And so the FASB Accounting Standards Codification Topic 805 and 810 deal with how you deal with business combinations, how you account for them. And of course, a business combination is usually when you have a parent and a subsidiary, although actually it includes other stuff too. You might not have it, as you will see here shortly, an existing subsidiary. You may end up with just the parent absorbing all of the assets and liabilities of the company they acquire. But anyway, bottom line is this is the diagram in the book. Not sure if it's completely representative of all business combinations though. Why do we have business combinations? Well, in this growing, fast market competitiveness, if you want to increase your market or expand your market rather than starting from scratch, you might want to acquire a company. You might want to acquire a company to get the synergies of both companies together, especially if they're like a supplier. You might be able to acquire them and gain a competitive advantage over your other competitors. So there's many reasons why. Back to this ASC topic 805 and 810, they provide guidance in using the acquisition method of accounting. And the acquisition method embraces fair value measuring for measuring and assessing business activity when you have one of these combinations. Now, notice it talks about fair value measurement, and as the book notes, this is different than in the past when the cost was used as the measuring stick. So this is a big difference that's occurred over the last decade or so. Now the reasons why firms combine, there are many. Vertical integration, meaning, like I mentioned before, you've got a supplier and you want to gain an advantage by acquiring the supplier so that, let's say, your competitor has to come to you to get their supplies, and plus by acquiring them, you can basically shut out your competitor from that supply if you want. Cost savings, just think of the cost savings of acquiring a company, and instead of having two of everything at the headquarter level, all those savings of building, executive staff, administrative staff, accounting staff, et cetera, et cetera, et cetera. Systems, lots of cost savings. Quick entry into new markets. Like I said, if you want to get into a particular market, you either have to start from scratch or acquire somebody who's already in the market and established. Much easier to acquire than to start from scratch. Economies of scale. What are they talking about there? Let's see. Oh, well, just being bigger, you're able to wield more power. You would have more negotiating power with banks, for instance, with suppliers, you name it. Same thing goes here, more attractive financing opportunities. You're now bigger. You can control negotiations with bondholders, banks, et cetera, et cetera. Diversification of business risk. You know, if you're in several different types of businesses where you might be down in one industry, you might be up in another. For instance, companies that are something I'm familiar with in the energy business, they might be in natural gas and they might be in oil. Well, where oil may be down now, natural gas may be up. So by diversifying, they've, you know, rather than being in one or the other but not both, they're able to at least smooth out some of the down cycles in the other type of business that they're in. Business expansion. Businesses expand for a lot of reasons, some of which we've talked about, but you know, if they want to increase their income and the return to the shareholders, then expansion may be the quick and easy way of doing this. Now, it's not always, doesn't always happen, but it certainly can be a vehicle for doing that. You know, they may have financial incentives in their own compensation for wanting to combine through and expanding. Increased, expansion can increase income of the overall business, and due to their financial incentives in their compensation package, increase their wealth as well as the shareholders' wealth. And again, increasingly competitive environment is pushing more and more companies to combine rather than starting from scratch or staying static. Some recent notable combinations, $34 billion. I mean, the book talks about trillions of dollars in combinations through mergers and acquisitions over the last 4 or 5 years. Here are some of them. All right, now we're going to recognize when consolidation of financial information into a single set of statements is necessary. And so Here, we start by looking at one of the FASB ASCs that says there's a presumption that consolidated statements are more meaningful and that they are usually necessary for a fair presentation when one of the companies in the group has a controlling interest. So the thought is that consolidated financial statements provide a more meaningful information than separate statements of the two or more entities. Consolidated financial statements better and fairly present the activities of the consolidated companies rather than if reported separately. Note here that in many cases, consolidated companies can retain their legal identities as separate corporations. Sometimes they do, sometimes they don't. All right, so here we're going to define the term business combination and differentiate across various forms of those combinations. And so a business combination refers to a transaction or other event in which an acquirer obtains control of one or more businesses. So obtaining control is the operative word here, or operative phrase. A business combination is formed by a wide variety of transactions or events with various formats, as we will see here shortly. Business combination can differ widely in legal form, and a business combination unites two or more enterprises into a single economic entity that require consolidated financial statements. And so, as the book points out, there are various types of business combinations. One of them is a statutory merger. That's where the acquiring company acquires the assets and many times the liabilities of the acquired company. And what happens after the acquisition, after the merger, the acquired company dissolves and goes out of business. You can have a statute, and so that's through asset acquisition, statutory merger through asset acquisition. You can have a statutory merger through capital stock acquisition of the acquired company. There, the acquiring company acquires all stock and then transfers assets and liabilities of the acquired company to its own books. The acquired company dissolves as a separate corporation, but oftentimes they remain as a division of the acquired company, or excuse me, acquiring company. Okay, so those are the two types of mergers. You can have either a merger through asset acquisition of the acquired company and a merger through capital stock acquisition of the acquired company. You could have a statutory consolidation through capital stock or asset acquisition. There, the two companies, the acquiring and the acquired company, are both going to dissolve. And so what happens here is that a new entity is created, and the new entity receives the assets or capital stock of both companies, the acquiring and the acquired. And then the original companies, the acquiring and the acquired, may either dissolve and totally dissolve or just remain as separate divisions of the newly created company. And of course, anytime you acquire more than 50% of the voting stock of another company, the acquired company, the acquiring company is going to record that as an investment, and at least on its face, it's assumed that the acquiring company controls the decision making of the acquired company. That's usually the case, but as we've seen, that's not always the case. And then, as far as that's concerned, the acquired company remains in existence as a legal corporation, although now they're a subsidiary of the acquiring company. Then, as we saw in Chapter 1, the variable interests entity. You can read that for yourself because that's pretty self-explanatory. We've talked about it in Chapter 1. And so the FASB provides guidance and defines control when accounting for business combinations with this control model. The FASB ASC glossary, in addition to majority share ownership, further describes control as the direct or indirect ability to determine the direction of management and policies through ownership, contract, or otherwise. FASB continues its efforts to develop comprehensive guidance for consolidation of all entities, including entities controlled by voting interests. And so they're essentially trying to identify the party who either has control, who has control, even if they don't have a majority interest in the acquired company. And so consolidation of financial information simply brings together the financial data of the parent and the subsidiary or subsidiaries to report the financial position, results of operations, and cash flows for the combined entity. As such, reciprocal accounts and intra-entity transactions are adjusted or eliminated to prepare a single set of consolidated financial statements. And so, first thing we have to discern is what is to be consolidated. Well, it depends on the type of consolidation you have. If dissolution occurs in the acquired company, all appropriate, well, that's true even of, if both the acquiring and the acquired both dissolve, as we saw with the statutory consolidation. If dissolution occurs of either one or both, all appropriate account balances are physically consolidated in the financial records of the survivor. If it's a statutory merger, either through asset acquisition or capital stock acquisition, the company dissolving is the acquired company, and so the acquiring company still exists. And in case of a statutory consolidation, both the acquiring and acquired company are both going to dissolve and this new company exists. In either case, all appropriate account balances are physically consolidated in the financial records of the survivor. If a separate incorporation is maintained by the acquired company, only the financial statement information is consolidated, and that's done on work papers, not the actual records of both the parent and the sub. You don't want to mess with those. When does the consolidation occur? If dissolution occurs, then permanent consolidation occurs at the combination date, the acquisition date. If a separate incorporation is maintained by the acquiring or acquired company, the consolidation process is carried out at regular intervals whenever financial statements are to be prepared. And last, how does consolidation affect the accounting records? If dissolution occurs, the dissolved company's records are closed out. Surviving companies' accounts are adjusted to include the appropriate balances of the dissolved company. If separate incorporation is maintained, each company continues to retain its own records. Worksheets facilitate the periodic consolidation process without disturbing, messing with, in my terms, individual accounting systems. Now, again, the valuation principles of the acquisition method, this embraces the fair value method, as we talked about, in measuring the acquirer's interest in the acquired business. And so applying the acquisition method involves recognizing and measuring the fair value of the assets, consideration transferred for the acquired business and any non-controlling interest, and then the fair value of separately identified assets acquired and liabilities assumed. And then any excess of the consideration transferred over the fair value of assets acquired and liabilities assumed is considered either goodwill or possibly a gain from a bargain purchase. So fair value is defined as the price that a willing buyer is willing to pay and a willing seller is willing to accept, basically. And so that's a price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The market approach estimates fair values using other market transactions involving similar assets. Okay, so what they're talking about here at this point are three approaches that you can use in determining fair value, okay? And so the first one is this market approach. So here we're just looking at similar transactions involving similar assets or liabilities and finding out what those were purchased for and then using those values in our deal. You can use the income approach, which relies on multi-period estimates of future cash flows projected to be generated by an asset. And last, you could use the cost approach, which estimates fair values by reference to current cost of replacing an asset with another of comparable economic utility. So what happens if the consideration transferred is not equal to the fair value of the assets acquired? Well, in that case, the difference is going to be attributed to goodwill. You probably knew that, right? And if the consideration is less than the fair value of the assets, you've gotten a bargain purchase and will record a gain on the acquisition. Okay, so I'm going to stop there, and tomorrow I'll pick it up in talking about the ways or the procedures for consolidating financial information.